In this video, we are going to take a look at an individual looking to pay $1 million into a policy, and he had a great question, which was, can I just write a check, fund the policy, and be done with it? But I still want to access it completely tax-free over time. So the answer to the question is yes, technically you can do it. However, it is not the most efficient method to fund a policy. So let's take a look here. We've got an age 60 male. We're going to assume we've got a 6% dividend rate for this example, and he's got $1 million he wants to pay into the policy. He says, Steve, can I just write a check to the insurance company for $1 million, fund a policy, and if it's earning 6%, that should produce $60,000 in interest, because if I had money in a bank account earning 6%, I would see what? $60,000, and at the end of 1 year, $1,060 in my account balance. That would be beautiful. Unfortunately, a cash value life insurance policy does not function in that manner, but we will show him how to design a policy for maximum cash value and really use it to the fullest degree, again, copying what a lot of big corporations and wealthy individuals do. So let's first touch on a question that comes up a lot here, which is this. Okay, if you're telling me a company earns a 6% dividend rate, if I give you $1 million, why don't I see $60,000 in interest? Like, why does that interest rate not reflect the actual growth on a life insurance policy? So here's why. With a life insurance policy, first, it has to do with the design. So when I pay money into a policy, where can it go? I can pay it toward the premium or toward that PUA component. What shows up in cash value in the first year? Nothing. So, of course, if someone's paying $1 million into a life insurance policy, we are going to minimize that premium as much as we can. We do it with any dollar amount, but minimizing the premium will allow more of his money to go toward cash value. However, if he had $100,000 going toward the premium, that's $100,000 that's not going to show up in cash value right off the bat. Beginning year 2 it will, and it gets better and better. However, when I look at the policy design fundamentals, whatever my base premium is, typically does not show up in cash value in the first year, sometimes the first and second year. Depending on the product and company, there's some factors where I will see it up front, but not showing up in cash value. So that's an insurance expense. I have this dividend rate, but I have to factor in the insurance expense as well. Another thing to look at is what is called my internal rate of return, my IRR, which is the net growth on cash value after the company credits, or I should say debits, all of their insurance expenses, mortality charges, meaning I have a life insurance policy where the company still says, hey, you're purchasing a product from us, meaning when you die, a death benefit is paid out. So yes, we have a dividend rate, in this particular case, 6%, but that is also a gross dividend rate that is credited after the company's insurance expenses and mortality charges. That might give me a net internal rate of return. For simplicity, call it 4%. So always good to be aware of that up front. Let's look at some bullet points here. So one thing I just want to mention is this individual said, hey, I want to write a check for a one-time payment of $1 million. I do not want to just come to him and say, well, you can't do that because it's not the best option. If someone did that to me, I would not work with them. I'd want to know why. Like, if they say, okay, you can't do that, it's not the best option, but here's the reason why, and here are some alternatives. If you're coming with $1 million, like, don't tell me just, it doesn't work, and let me show you an option that I prefer. No. You gotta be transparent with this stuff. Like, I can purchase different products from Amazon, and then I can see, hey, this product does not fit for me. But it's pretty transparent that option A or option B that came up on the right of the screen is a fit, so click, I'm gonna buy that one. So how can I do the same thing with cash value life insurance? And we're working on that. We still need a lot of videos to do so. But here we go. So what we'll cover: why a one-time payment is not the best option, a lot on the MEC, the Modified Endowment Contract, specifically the initial MEC test and the 7-pay test. Then we're going to look at current rates, the current dividend rate, Also, guaranteed values. This is very important to look at in all scenarios, particularly lump sum cases when I'm not funding a policy for 7 years. I want to see, based on a worst case scenario, the guaranteed values. Will my cash value continue to appreciate? And will I not run into a modified endowment contract? And then, of course, if you're considering this, how do I maximize the cash value? That's it at the end of the day. So, modified endowment contract. What are the core benefits to a cash value life insurance policy? Safety, not invested in the market at all. I've got my guarantees, it goes nowhere but up. Liquidity, I can access that cash value anytime I want. And then number 3, tax-free. I can get to that money completely tax-free unless I trigger a modified endowment contract. If a policy becomes classified as a MEC, I have to deal with income tax on the cash value when I access it. Gross tax deferred, but if I want to pull it out, I've got to deal with income tax. So how do I prevent this? Well, every policy has what is called a MEC limit. We're going to go over the initial MEC limit here, which is when I first start a policy. I can set that MEC limit wherever I want, and you'll see how I set it. What it has a direct relationship to is your age and death benefit. Gender plays a role as well, but age and death benefit are the primary factors. What you'll see is if this individual, a 60-year-old male, wanted to pay in $1 million and he wanted a non-MEC so he could reap the tax benefits, in order to have a $1 million MEC limit, he would need a death benefit of guess how much? $14.25 million. We're going to show you that example too. So we're going to look at examples of a policy that's a non-MEC, a policy that is a MEC, so we can see the pros and cons. Here's another thing, is if I want a policy that is a non-MEC, I have what's called a 7-pay test, 7-pay premium test. It's another name for a MEC test on a life insurance policy. What it has to do with is the first 7 years of a life insurance policy. Wherever I start that death benefit, so if I started it at $14.25 million, that death benefit must remain intact at $14.25 million for at least the first 7 years if I've paid the $1 million in up front. If I were to reduce the death benefit, which would therefore reduce the costs, allow the cash value to grow at a greater rate because I have a lesser cost or lesser drag, now all of a sudden I would see more money. But I have to be aware of this MEC limit in order to reap the same tax benefits. So let's look at a one-time payment first, and then we'll transition into how to maximize the cash value. But what we're going to look at here is a one-time payment that is a MEC. It also is not a MEC. We're going to focus on this MEC test here up front. This will be fun. So on the left, what do you see? A $1 million payment. Age 60 male, $1 million payment. Base premium, lower than 10%. We're able to do that in this example. $80,500. Initial cash value, about 91%. You can do this with MEC policies. Now, death benefit is what? $3.4 million. Here's what I want to touch on without whipping up the software and going through all that stuff, is the MEC limit, based on that death benefit, is going to fall right around $240K. He paid in $1 million. So this cash value will look attractive. I've got 91% up front, breaking even between years 4 and 5 at age 60, one-time lump sum. Looks pretty strong for a whole life insurance policy with the long-term benefit. The thing is, if I ever want to access any of that cash value, especially beyond year 4, I'm going to be taxed on the gains as ordinary income. Now the death benefit is still paid out income tax-free, which is a nice advantage, but if cash value is my play, I have to deal with taxes here. This is a modified endowment contract beginning year 1. Now, example number 2, $1 million lump sum, but we MEC'd out in year 4. So what happened here? So look at your death benefit right off the bat. Look at that, $14.25 million. For an age 60 male, that death benefit gives him a MEC limit of guess how much? $14.25 of $1 million. That's the death benefit I'm writing out there. So $1 million MEC limit. Okay? Now here's what I want to touch on here. He pays in $1 million. There's his base premium, $80,500. We also have a term insurance rider attached to this policy. That's how we got that death benefit higher with keeping the premium exactly as the same compared to what you see on the left. But that term rider is why you see the difference in cash value here. That is a big term rider for a 60-year-old male. It's huge. Wouldn't recommend this type of design, and you'll see that as we progress through the more efficient design. But year 2, what I want to touch on, in red, this $80,500, this is the base premium that's still due, but he's not paying it. Premiums due, nothing out of pocket, meaning he's allowing the dividends and interest to first pay the premium, and then the excess is kicked back into cash value. So we see about $10,000 in growth. Next year, same thing happens, premiums due, your net out of pocket is 0. Cash value grows by about $2,200, not that much. Then all of a sudden, look at the next year, you see a big jump in cash value growth, 909 to 945. Why that happens is, again, you're out of pocket 0, but that premium's gone. So we killed it here with what is called a reduced paid up option, which completely gets rid of the base premium, not even due. If I wanted to pay into it, I cannot. However, what's in red up here? MEC'd in year 4. The year we chopped the premium off and killed the insurance expenses, what happened to your death benefit? Dropped down substantially. So because that death benefit dropped within the first 7 years of a policy, going back to that 7-pay test, how the MEC limit looks at a policy for the first 7 years, we violated that 7-pay test, and now as a result, when that death benefit dropped, we MEC'd out. So now cash value picks up the pace when we kill the premium, but we don't have much access to it. We've got to deal with taxes, and that defeats the purpose of cash value life insurance if cash value is our goal. For death benefit purposes, MECs can sometimes make sense. But then on the far right, we've got a non-MEC. So here you go. Same $1 million. I cannot write straight today. There we go. Non-MEC. Identical in year 1. 1 million in. There we go. Cash value, about 900,000. Death benefit, 14.25. Base premium, we covered it in the first year. So that $80,500, that was paid from the $1 million deposit. Same thing with the term insurance rider. Beginning year 2, premium still due, but you are not paying it. 0 is your out of pocket. Here's the difference. Look at this. Year 7, or I should say year 8, we chopped the premium off altogether. So on the illustration, it's not even there anymore. We're going to show you a snapshot of that as well for a different example, the most efficient example. But here, we chopped it off. So this policy represents a one-time lump sum of $1 million. It is a non-MEC because we kept the death benefit at the initial 7-pay premium test, that 14.25 death benefit, really for that $1 million MEC limit. We kept it there for 7 years, and then by reducing it year 8, comes down quite a bit, but no MEC. So I have access to the cash value all the way through. But look at that. Ugh. Looks like a traditional whole life insurance policy. Takes me 12 years to break even based off of the present dividend rate. Wait until you see the guarantees on that option. So non-MEC, which is great, but compared to the MEC examples, big difference in cash value. So if I want a non-MEC, which everyone wants, I don't want to modify an endowment contract 999 out of 1,000 cases. If that's the case, I do need to be mindful of this 7-pay premium test. So let's maximize the efficiency now. Let's look at some alternatives in order to optimize the individual's cash value, looking at the present non-MEC example as well, the $1 million lump sum, and then also spreading the payments out based on the current dividend rate and also the guaranteed rates. In this example, 5.65% is the illustrated dividend in this example. The actual Excel sheet. Dividend, here we go. So on the left, this will look familiar. $1 million lump sum, non-MEC, there it is. Premium, still due, not being paid out of pocket. Your net out of pocket is 0. This is the same example we just looked at, breaking even between years 11 and 12. Now what we're going to do is spread the payment out. So the same $1 million out of pocket for the individual, paying it in over 3 policy years, which if you swing that right could be done over 18 months through policy backdating. Could also allocate it into a prepaid account, which I'm not a huge fan of, but really we can park money with an insurance company. They may credit 2 to 3% interest on the money while it feeds the life insurance policy. Why I'm not a big fan of it is we do not have access to that money as it's being fed into the policy. It's parked with the company. However, what we want to look at here, look at this, 1 million, same out of pocket to the consumer, broken up over 3 years, minus $1. Base premium, $30,000, compared to the example on the left, $80,500. It's about 9%, a little bit more than 9% on the base premium relative to the total payment. So, reduced the premium. Death benefit, $4.75 million. That gives him a MEC limit of, guess what? $333,000. So we solved again for the minimum death benefit in order to be able to allocate $333,000 per year into the policy for 3 years. And you can continue to pay into it if you wanted to. Each year, he could also commit to just the minimum premium and then throw in the rest of the money whenever he wants. But look at the difference in performance. Now all of a sudden, we're breaking even year 4. World of difference by spreading out that payment. What's happening here is that base premium, first 2 years are most critical here. He's covering it out of pocket. So by the time he hits year 4 and says, okay, I got my $1 million in, Steve. You told me I don't have to pay anything after the $1 million. Show me how it works here. Premium is still due. He's not paying any of it out of pocket. Annual outlay is 0. Policy cash value continues to grow quite nicely as well. So what this means is the policy's dividends and interest are paying the base premium, and then the rest is kicked back into cash value and continues to increase over time. Year 8, look at that. Consistency. Death benefit drops. We reduced it at year 8. If he wanted to keep paying, we wouldn't reduce it. But in this example, lump sum, be done with it. This is how we optimize it. All right. Now let's look at the example on the far right, which is breaking it up over 5 years. $200 for 5 years. Minimum premium, $18,000 and change. You pay it for 5 years, and there's 2 years of drag. What I mean when I say drag is a base premium that's still due, and I'm not paying it. Why I refer to it as drag is the dividends and interest need to pay the premium first instead of coming back to cash value. That's why I like the term drag. It's dragging or slowing down my performance. I can't move at the fastest pace possible. Death benefit, $2.9 million. Gives me a MEC limit of about $200K. It's actually about 203 in this example. We rounded. Let's take a look at this because I'm spitting these MEC limits out at you, and that can be a bit confusing. How do we actually find that is the question. Well, people have a tendency to believe what they can see, not always what they can hear. I'm the same way. So here we go. Here's that exact same policy, just a detailed ledger. Where is my money going? Premium. PUA. Term rider, about 2.6 million. Cost of the term rider. So his true minimum cost is that $2,600 plus the $1,800 and change. So that's the true minimum, and then everything else he's plowing into PUAs, hyper-growing the cash value. Now here's what I want to touch on specifically, because the cash value, the net outlay. This all matches the Excel sheet. We always pull all of the data from these illustrations and put it right on the Excel sheet. Anyone that works with us gets it all, so they see it all, meaning the illustration and the Excel sheets. Net death benefit. This guy, 7-pay premium, another name for my MEC limit, $203,000. So what we did with this design is solve for the minimum base premium, minimum death benefit, minimum term rider in order to minimize expenses, maximize the cash value. This is exactly how to optimize the cash value on a life insurance policy. How do I minimize the costs, beef up the cash value? That'll give you optimum value, short-term and long-term, based on the current dividends today. What you'll also find is if you're very conservative and you like to look at this, the guaranteed values, let's take a look, shall we? So this option, current dividend value, what do you notice as you compare? The good ones break even year 4 on both of them. However, year 20, is there much of a difference? Not really. 1.752 compared to 1.768, based off that span of 20 years. Hey, some people prefer to go with the 3-pay because they get the money in here sooner and it's an opportunity cost that I can use for other things. With that said, here's what I like to look at. Don't get me wrong, I'd like to sell this one instead of that one because this will generate significantly more profit, but for full transparency, that's important. Here are the same scenarios, but based on the guaranteed values, worst case scenario. What do you notice now? I don't even need to look at this one. This never breaks even the one-time payment. Over 3 years, breaks even year 10. So I paid in $1 million. There's my MEC limit or my death benefit, which generates my MEC limit. Look at this. When that premium's still due, what happens to your cash value here? Goes down. When we hit the kill switch with the reduced paid up option, then what starts to happen? Cash value comes up and gets better and better each year. So based on the guaranteed values alone, that premium for 4 years is too high to sustain the policy, meaning the dividend or just the guaranteed rate is all covering the premium and there's a shortfall too. That's why I see my value coming down. Example on the far right, we've covered it for 5 years now. Say, okay, I've given you a running start now, Mr. Policy. You're on your own, and now it can start to fly. It doesn't need any more, it doesn't need to push. You can see this right here. The next 2 years, cash value keeps going up. Then we hit the kill switch, and it goes up by even more. So it is drag, but much less. And this is what's valuable to see. Now, at the same time, if we were to fund this for 7 years, spread the $1 million out over 7 years, you'd see a different scenario. This would actually still be more favorable. My age is important. If I'm older, say I'm 65, say I'm 70, then it makes sense to spread a lump sum out over 6 years. 6 years typically, maybe 7, but it's rare, typically 6. If I'm younger, I can condense the funding. So age does play a role in this scenario, and we've got other lump sum studies as well you may have seen before. But if you have questions, would like to see any samples of lump sum payments or any type of design, please feel free to reach out to us anytime. We'd love to work with you. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.